Welcome to the Case Study Learning Series in Marketing Management by Skilled MBA. In this session, we dive into the strategic growth dilemma facing Polymatic Plastics and Packaging, also known as PPP. Founded in 2016 in Ludhiana, India, this SME specializes in bubble packing and stretch film manufacturing. Now at a crossroads, PPP must choose between two contrasting paths: deepening its market presence locally, or expanding geographically into new regions. Through this case, we'll explore how entrepreneurs like Shantanu evaluate market forces, financial constraints, and growth potential when plotting a sustainable path forward. PPP began its journey as a proprietorship in 2016 with a small-scale facility producing bubble packaging and stretch films. Core business: custom packaging solutions tailored to local B2B clients. Business model: combining fast turnaround with quality assurance. By 2019, the company had scaled up capacity and diversified its product offerings. However, by 2020, intensifying competition and margin pressures forced founder Shantanu to reassess growth strategy. He now faces a strategic dilemma. Should PPP strengthen its roots in Ludhiana or explore new territory? Understand geographic expansion. Assess when and why small businesses need to move beyond local markets. Evaluate business dynamics. Identify challenges entrepreneurs face throughout business lifecycle stages. Develop growth strategies. Create effective strategies for businesses facing intensifying competition. India's packaging sector is booming. Annual growth rate: 10 to 12% across various segments, driven by e-commerce, FMCG, and exports. Plastic packaging remains dominant due to cost-effectiveness and durability. Demand for stretch films and bubble wraps is rising, especially among electronics, pharmaceuticals, and logistics sectors. However, the surge in demand also brings fierce competition, with regional players entering aggressively, particularly in hubs like Ludhiana. Polymatic Plastics thrives on four pillars: manufacturing excellence, high-quality inputs, modern machinery, and rigorous testing. Quality assurance: batch-level inspections, standardized processes, and low defect rates. Fast local distribution: delivering within 24 to 48 hours in Ludhiana, reducing lead times for clients. Personalized client service: custom sizing, branding, and flexible MOQs to match business needs. This operational focus has won them 32% local market share, but also drawn attention from competitors. Let's walk through the milestones in Shantanu's journey. 2016, founded PPP with limited capital and machinery. 2017-2018, secured steady local clients known for responsiveness and reliability. 2019, expanded product range and added machines to scale up. 2020, faced with pricing pressure and growing competition, leading to strategic reevaluation. At this point, he must decide: deepen his home turf advantage or explore nearby high-potential markets. Ludhiana, while a strong base, is crowded. 18 direct competitors, many of whom compete aggressively on price. 4 dominant players control 65% of the total market share. PPP holds 32% share, but this is under threat due to new entrants, shrinking profit margins, 8% annual decline, rising input costs. If PPP stays local, it must invest in differentiation, not price wars. To fortify Ludhiana operations, PPP could differentiate products, develop eco-friendly, branded, or high-strength films to stand out. Service excellence: invest in even faster fulfillment and broader customization. Strengthen client relationships, loyalty programs, bundled pricing, and proactive engagement. Vertical integration: offer design consultancy or inventory management. Becoming a packaging solutions partner, not just a supplier. This strategy is moderate risk, cost-effective, and could yield quicker results. Alternatively, PPP could enter nearby cities. Chandigarh, 93 km, an administrative hub with growing industrial needs and limited packaging competition. Amritsar, 135 km, a trade gateway with export potential, especially for textile and handicraft sectors. Delhi NCR, 310 km, a massive market with huge demand, but high capital requirements and entrenched competition. Expansion offers long-term volume potential, but requires greater upfront investment, logistics setup, and branding. Let's assess PPP's strategic position. Strengths: solid brand reputation in Ludhiana, high product quality, speedy local logistics, client retention track record. Weaknesses: limited scale and reach, capital constraints, unknown brand outside Ludhiana opportunities, untapped nearby markets, e-commerce packaging demand, shift to sustainable materials. Threats: price wars, regulatory changes, raw material price volatility. This analysis suggests market deepening is safer, but expansion could unlock transformative growth. Let's compare the resource needs. Category market deepening, geographic expansion. Initial investment, Rs10, 15 lakhs. Rs30C, 45 lakhs. New personnel, 3 to 5 employees, 8 to 12 employees. Implementation time, 2 to 3 months, 6 to 9 months. Annual marketing cost, Rs5 to 8 lakhs, Rs12, 18 lakhs. Risk level, moderate high. This reinforces the trade-off: faster ROI versus higher future scale. Each path offers different growth outcomes. Optimistic scenario: market deepening yields 35% annual growth through differentiation. Expansion into Chandigarh plus Amritsar may deliver 40-50% CAGR over 3 to 5 years. Moderate scenario: 18 to 22% growth via partial execution of either strategy. Conservative scenario: 8 to 12% growth by continuing the current model with minor improvements. Financial modeling suggests expansion has longer break-even but higher strategic upside. Shantanu must now evaluate using 4 filters: market assessment, which cities offer low competition and high industrial demand; financial analysis, what's the expected ROI and break-even period for each path; operational planning, can the current team manage a dual city or hybrid strategy; decision execution, are we ready for phased, test-based expansion rather than an all-in bet? This framework reduces uncertainty and aligns decision-making with long-term goals. To balance ambition and caution, a 3-phase hybrid strategy is proposed. Phase 1: strengthen core. Invest in Ludhiana differentiation, build deeper defenses. Phase 2: limited expansion. Open a satellite facility in Chandigarh. Pilot operations with minimal risk. Phase 3: strategic scaling. Use learnings from Phase 2 to decide on Delhi NCR entry or further deepening. This stepwise approach allows data-driven decisions, controls risk, and adapts based on feedback. This case offers valuable lessons for entrepreneurs. Growth isn't just about scale. It's about strategic fit and operational readiness. Market deepening improves resilience. Expansion builds reach and value. Hybrid models offer flexibility and reduced risk in uncertain times. Decision-making must balance data, intuition, and strategic pacing. PPP's journey mirrors challenges faced by many small manufacturers seeking to scale smartly. To conclude, Polymatic Plastics and Packaging's strategic dilemma isn't a choice between right and wrong. It's about finding the right path for the business stage and resource reality. Through thoughtful analysis and phased execution, entrepreneurs like Shantanu can unlock sustainable growth while staying true to their vision. Thank you for joining the Case Study Learning Series in Marketing Management by Skilled MBA.